Hello and welcome. In this video, in the series of videos that I'm doing on moving business abroad, the various considerations. In this video, I'm basically taking up the risk of getting the Indian operations of your Indian leg of your operations qualified as a permanent establishment. What first of all, I want to explain what is PE, what are the consequences if your Indian operations fall into a PE, classify as a PE, and how to protect your Indian operations in so as to ensure that they don't qualify as a PE. So let us look at it point by point. So the first of all, the myth is that the myth is that if you just incorporate a company in a low or a zero tax jurisdiction, for example, a UAE, a free zone in a UAE, will save you the India's tax, the 30% tax that you pay in India. No, it's a myth, right? Just by simply incorporating the company does not mean that you will save the tax in India. Indian tax law has enough provisions to ensure that such an income is taxable in India unless and until you rely on the DTA between India and that jurisdiction, and under the DTA, that particular operation that you have in India, business activities, do not fall in the definition of permanent establishment, right? So Indian tax law has dedicated provisions, like I discussed in a separate video on tax considerations while moving your Indian business abroad. You have Section 9 of the Income Tax Act, the provisions regarding place of effective management, business connection. Then there are GAR and SAR provisions, which say that even if the objective was only tax savings, then we will disregard even the DTA benefit, and the GAR basically even overrides the DTA, right? So all these kind of provisions are there. So you need to ensure when you structure the transaction that it does not attract Section 9 GAR SAR provisions. It does not attract the MLI provisions related to principal purpose test. It doesn't qualify as a PE. All that you need to check, and then only you can kind of be safe that it will not be taxed in India. Still, there will be some residual risk of litigation with the Indian tax department, because Indian tax department is very aggressive on source based taxation, as with any other country, right? Every country wants to protect its base and not allow the profits to shift to a foreign jurisdiction. So you need to do a proper analysis. To escape Indian tax rigor, we rely on the DTA, right? So we rely on the DTA, right? That in the operations should not qualify as a PE. In the DTA, generally there is an article with respect to PE, permanent establishment. If the activity does not fall into permanent establishment activity in India, there is no tax. So basically, the general rule is no PE, no tax, right? So very, very important to see what the language of that ETA says, whether the activities of that enterprise with the Indian activities fall into the PE. If yes, then there is a risk that the foreign companies' profits to the extent of Indian operations will be taxable in India. There are certain detailed rules with respect to attribution of income. I'll not go into that. Right. So we need to ensure there is no PE. Right. Okay, what is PE? A very, very important concept in international tax. So basically, the as per the international general principle in the international tax law, the profits are generally taxable only and only if there is a some permanent establishment, right? Only then the country has the right to tax. That means India has the right to tax the operations of a particular company, maybe a multinational company, only and only if there is some kind of a presence in India, right? What is the type of presence? Now there are different types of P's that are defined, like fixed place PE, construction PE, service PE, right? The various types of P's are defined as per the language. Agency PE, right? So either there's a fixed place of business in India, either you have an agent who has the authority to conclude the contracts in India, or an agent who habitually acts on your behalf in India, employees of the foreign company performing any services in India, or any, like in case of construction companies, building, construction, mining site, right? So that whole definition you need to see in the DTA. Now, so that exact wordings has to be seen. Now, if those wordings are not clear, we rely on the OECD commentary. Right? The OECD commentary is available. You can rely on that. And then there are judicial precedents. So for that particular article of that country DTA that India has, there are specific judicial precedents that needs to be checked. What the judiciary has already decided on this matter, and now we have the MLI also. Now, if this was not enough, now there is the as a consequence of the BEPS action plan, now there is a MLI also that needs to be checked, whether because that now forms an integral part of the DTA, so that also has to be examined. So this is a very very comprehensive kind of a very meticulous task that has to be done on the PE aspect, and it is a highly litigative area of international tax law, right? Okay. Highly litigative subject, always a residual risk of litigation will remain. So either you decide that you wind up all the operations in India and move outside India. That is not always possible, because there's a whole lot of things that have already been running in India, and India can invoke SAR, GAR, or PPT, principal purpose test, and try to tax the income in India. So Indian tax authorities have always been aggressive in taxing such incomes. So we need to take extra precaution, right, when structuring moving Indian business abroad. Best and lowest risk option is move completely out of India, right, and move even the partners, the directors, move out of India, escape the Indian tax provisions, escape the Indian FEMA provisions, and then do the business out of India. But that is not always possible, because there are existing interest families that are there in India. So that whole complexity gets created. Now, if you have a business incorporated outside India, for example, a free zone, some part of activities in India constitute a PEE in India, your company's operations will be deemed to the extent of the Indian operations. So your UAE free zone company is catering to foreign clients, clients outside India as well as clients in India. So if the Indian operations of that UAE free zone company are designated as a PE in India, then to the extent of the UAE free zone company's business income, which is attributable to the Indian operations, it might be that that particular attribution relates to a servicing of any foreign client of third, like a Singapore client or a Malaysia client. Even that will qualify as a to be taxable in India. So that care you need to take. The consequences of Indian operations deemed to be a PE, the profits of that foreign company will be held as taxable at 40% plus rate in India, right? Because the 40%, the foreign company is deemed as resident of India under the DTA. So once the foreign company is deemed as a resident of India, then India will not give any DTA benefits to that particular company. And so whatever kind of structuring you had done with respect to lower withholding rates and all will all go for a toss. So very important to manage the P risk at initial stage when you are even conceptualizing the whole transaction. Then only you need to sit with your Indian CA and sit with your UAE or any other country, the CPA, and structure this whole transaction so that nothing is missed. So both sides you need to check, right? So if you have UAE company, you need to also check on the UAE side, and you also need to check on the India side. So first of all, what basically you need to do is you need to choose the right structure. So in India, either you can have a branch office or a kind of a project office, but the best structure that is advised is a kind of private limited company, right? That will be the, to protect from the PE risk exposure. So setting up a private limited company instead of keeping it unincorporated like a sole proprietorship or an unincorporated partnership, a proper private limited company is a better option, right? Okay. Now activities of that company, right? So whichever activities that you plan to continue, they need to be monitored to ensure that it does not fall in the definition of the P. Now I've created a simple checklist, a PE risk management checklist of some points which you can ensure. Ideally a detailed examination of the Indian activities needs to be done. The contracts need to be checked, right? What are the activities that are being done? So that detailed examination, but here I'm just trying to give a overview, some pointers so that you can take care of those. Foreign company to remunerate at arm's length price, right? So if there are both the companies, the UAE company and the Indian company are associated enterprises, you need to ensure that a proper TP study is done. TP, as per the TP compliances, you need to ensure that the remuneration to the Indian company is done at arm's length. If you remunerate anything less than the arm's length, Indian tax authorities can say that no, we will charge you the tax as on the arm's length price, right? So you need to take care of those. Clear demarcation of the roles, responsibilities, and risk rewards between the UAE company and the Indian company. No solicitation by the Indian company employees, no going out soliciting business for the UAE company by the Indian company employees, right? So that roles and responsibilities demarcation, proper education and training to the staff need to be given, that the solicitation will only happen to from the UAE company, not from the Indian company, right? Then execution of employee contracts, HR sourcing, HR policies, all the management of the Indian employees has to be done by the Indian company, not the foreign company. Because if it is seen that the foreign company is kind of controlling the whole thing, then it can be said that then it becomes a kind of a P, right? Whereas if there's a very clear evidence that everything was done by the Indian company, sourcing, all the policies, management of the policies, execution of the policies, contracts, employee contracts have been executed by the Indian company, then that thing is demonstrable. So one thing is to have the kind of segregation between foreign company and the Indian company, and second thing is to demonstrate, because at the time of assessment, right, tax assessment, you will need to demonstrate all these things: the TP study, the TP compliances, the contracts with employees, contracts with clients, all that you need to demonstrate. Then if you have the foreign companies employees coming into India, then you need to ensure they stay for a limited time. Now every DTA, the PE article mentions a kind of a time limit after which they may classify as a service PE, right? So you need to monitor the time. Fixed place PE thresholds also you need to monitor. They should not have any dedicated place in the office of the Indian company or any other premises in India at their disposal at all times, right? You need to take care of that. Foreign company has to restrict the control over the activities of the Indian company, right? So it should not be construed that the activities of the Indian company are totally directed by the foreign company. So yes, foreign company is a subsidiary, but somewhere that roles and responsibilities need to be defined. Then contracts correspondence conduct by the Indian company should not indicate any authority given to the Indian company to negotiate or conclude the contracts on behalf of the UAE company. So those contracts, the fine wordings need to be also checked. Then all the marketing material that you have, like for example, now the company is a UAE company, so when it interacts with clients, it has to show that it's a UAE company. The client's contracts should be done by the UAE company, the invoicing should happen by the UAE company, all the social media references, the networking websites, and wherever it's mentioned, only the foreign company's name should be mentioned, right? So that whole vetting aspect of the marketing material from a compliance perspective should also be done. Then have a fixed place in foreign company with dedicated. So the foreign company has to have a fixed place in, like say, the UAE free zone with clearly defined roles. The employees should be there, and there should be one designated employee for overall management of that company's office. All this is very much required because of the compliances required under the law of that foreign company, and second, to get the TRC, to ensure that the company is wholly managed from that particular location. Depending upon what is the TRC, India UAE DTA mentions that the company has to be managed, wholly managed from UAE. So you need to ensure all these things are in place. Conduct board meetings of that foreign company in foreign company, take the key management decisions there, maintain the minutes of meeting, so of decisions, so that tomorrow Indian tax authorities cannot say that the place of effective management was there in India. You have the demonstrable evidence that the people, the directors traveled to that foreign company. There are passport entries that show they were there when the decisions were taken, and key decisions were taken in of that UAE company. So all that planning has to be done, right? Then close the existing client agreements that you have with various vendors across the world in India. Execute fresh client agreements from the foreign company, and then invoice from the foreign company. So these are some of the kind of risk management kind of a checklist I've tried to share. All these points need to be very carefully thought of before taking this decision. So I hope this video was useful. If you have any comments, thoughts, do share in the comment section. Thank you so much for watching this video. Thank you so much.